As we head into 2026, we wanted to share an update to one of our favorite slide decks, the Why Stay Invested deck. And so if I go all the way to the end here and just basically say, what's the point of all this that we're going to share? It's really two things. Let's help to identify how often things can trip us up because they happen each and every year. And then what's the benefit of staying invested? How does it help us meet our goals over the long term? And we'll show you, we hope, pretty clearly in several examples about that. So we'll start here on the first slide. Growth of $10,000 invested in the S&P 500, December 1979 through the end of last year. So a 45-year period. So what you see is if you put that $10,000 in and you just went to sleep, you didn't put money in, you didn't take money out, you just let your dividends reinvest and grow, you ended up with about $2 million over that 45-year period. And if we jump to the side here for a minute, this is an interesting kind of time period. Because if you start your career in your early 20s, 45 years later puts you in your late 60s. So this is a working career, kind of a saving career type of time period. And you can see what compounding does from 10,000 to 2 million. So maybe the first year of your career, you can't save 10,000, but if you keep saving, in this example, we didn't. But if you keep saving throughout time, you put yourself in the position to be able to, to be in a similar situation and have the resources you need to be able to retire. So moving back to the chart itself, what we're seeing here is that over that 45-year period, there's about 10,000 trading days. But if you miss just the best 5, that first bar over, it costs you $750,000. You miss the next 5 for a total of 10, it's cost you over $1.1 million. So you're less than half the accumulation than if you just stayed throughout that whole period, and it goes on from there. So again, staying invested proves pretty valuable to you. And the reason why is on this next slide, and this may be surprising to a lot of people, but the majority of these periods, the best and the worst days are pretty close together. So here we look at 10 days apart, so just call it 2 weeks for the sake of ease. So the best 5 and worst 5 days are within 2 weeks of each other 60% of the time. Top 10, 80% of the time. Top 30, 77% of the time. So the vast majority of the time, those days are close together, which is why it is so hard if we say, okay, I'm uncertain, I'm going to take my money out and go to cash. If we miss, we often are going to miss those good days because they happen quickly, and then we end up in that prior chart where we've just given up some of the best days in the market, and it has a dramatic impact over a 45-year period. So we know that investing is about probabilities. There are no certainties, and that's not just a compliance disclaimer, it's the reality. So really what we're trying to do is what probabilities and what decisions put us in the best position to be successful based on what we've learned from history. Speaking of probabilities, so this takes a look at over various periods of time, how often are your returns positive? So as you get out to 1, 3, 5, and 10 years, kind of 3 years in particular and above, you're seeing 84, 87, 93% of the time, you've had a positive return over that period. You'll see charts that have 100 on the right here. Those usually start after the Great Depression. I wouldn't focus on that. It doesn't really matter when you start. The point is the same. You're going to see the same pattern with an upward slope and a higher probability the longer you're willing to be invested. This next chart's a little bit deeper, so give me a second here to explain it. What you're looking at in white are the ending year price returns for the S&P, and in blue is basically the lowest, the trough each year. So if we start at January 1st, did the market fall during the year, and how far? What was the deepest point? That would be the blue bar, and then where it ended would be the white bar. So if you look at the banners first, 75% of the years, 76% of the years, those white bars are positive. We've seen a positive return over this period. But if you look at the blue banner, 94% of the time, almost every year, the S&P has been negative at some point on a price basis. So if we make this real, let's look all the way to the right, and this was last year. This was 2025. Often we have to go way back into history. This time we only need to go back about 6 or 9 months. So if you look at that blue bar, down 15, that was April. So that was around the tariff turmoil and the huge amounts of uncertainty that were right there. But as you see in the white bar, by the end of the year, not only did we recover that down 15, we ended up 16 on a price basis, a little bit higher on a total return basis. And so this is a shining example of where it would have been really easy. April was a scary time. Markets were going down in huge chunks day by day, lots of volatility, lots of uncertainty. If you were going to go to cash, that would have been a reasonable time where you could say, you know what, I don't blame you. However, markets rebounded very quickly when some of that uncertainty cleared. And had you gone to cash at that period, you probably would have missed most of the recovery back to zero. And depending on how long you waited, maybe even some or all of that gain to 16. So last year's a great example of how dangerous it can be to try to market time. And if you're off by just a little bit, it can cost you. Positive and negative years. So look at this slide here. You could almost again zoom out and just take a look at the size and the stacks of the bars here. So white are positive years, blue are negative years. So your eyes just tell you there's a whole lot more positive years than negative years. The reality is correct. So 74% of the years have been positive. Negative years, 26%. So this goes all the way back to the inception of the S&P 500. The other thing you see is the white stacks are just bigger. So there's, not only is there more of them, the returns are higher. So as you move from the middle of the slide to the right, those are higher returns. First column is 0 to 10, next is 10 to 20, the following is 20 to 30, and then the far right is 30 plus. And we go the opposite way with the blue. And so what you see is if you go all the way out to the left, there are only 6 years where the S&P 500 finished the year down more than 20%. It may have been there or worse than that, during the year, but finished the year down more than 20. So that's an important point. I think we'll get into that a little bit more on this next page. So what are the percent of the years where the index falls by 10, 15, 20, or 25% at some point during the year? So basically, how hard is it going to be? How uncomfortable are we going to be? And how often? So if you look at the left, the white is the NASDAQ, so looking at growth stocks, blue is the S&P, looking at kind of core, if you will, and gray are value stocks. So you see, a 10% decline, kind of a run-of-the-mill correction, if you will, happens fairly frequently. So 4 out of 10 years for growth stocks, kind of 1 out of 3 years for core and value. So pretty often, to be honest. We should expect to have to deal with being down. That other chart showed you that. But being down, 10 to 20% happens in a reasonable amount of time. However, we go all the way out to the right, these are 25+% declines. So again, not that it finished here, but that the market fell at some point by 25% or more. If we just focus on the blue, which is the S&P, 8.5% of the time. So 1 out of 11, 1 out of 12 years, we have to deal with this. And so that's honestly not that often. So most of those years, we don't have to experience that. So if we're planning for it, we just need to balance how much we're protecting against that. And your needs or your life cycle or something may influence that, and that's fine. But for the run-of-the-mill investor, protecting against a 25% decline might not be the best use of your money if you've got a long enough time horizon. Last one here, and then we'll let you go. This is affectionately referred to as a quilt. So you see the colors dance all over the page. So again, kind of zoom out, don't worry about the words, and just look at the colors and how they move all over the page. So each column is a year, 2015 through 2025. Each color represents an asset class or a segment. And you really just see those colors move up and down those columns all over the page. In fact, there's only a couple of times where you see the same color at the top or at the bottom 2 years in a row, and never 3. You also see that white box in the middle, which is just basically rudimentary diversification. 60% stocks, 40% bonds. And what that allows is a smoother ride. So you see it's largely in the middle, if not a little bit north of the middle. There's that 1 year where it's a little low, but the vast majority of years, much smoother ride than the other colors, which can go from top to bottom, bottom to top, all over the place. And so what this allows is, we do a great job of extrapolating the past into the future. So 2023, large cap US won. 2024, large cap US won. Heading into 2025, what do you think most people said was going to win? Large cap US. And that ended up not being the case. So when you have this, even the most basic diversification, what you are able to achieve is not only the things that did well last year, but the things that might do well this coming year as money rotates, because we never really know what that's going to be until we're looking backwards at the end of the year. So hopefully this encourages you to make a plan, to stick with it, to find that balance of how much risk you want to take that allows you to stay invested when the markets go down, because they do nearly every year. And so you can stick to your plan and achieve your goals. Thanks for your time.